Let's stick with the markets now. Bring in Ellen Hazen, portfolio manager at F.L.Putnam. So, Ellen, we got those strong retail sales numbers today, but despite that, you are cautious, let's call it, on the market for 2022. Tell us why.
I want to distinguish between the economy and the market. I think the market has already increased by 20+% this year. So we're looking at a market which is outgrowing its ability to grow earnings too quickly. But the economy is actually in very good shape. You saw that with the retail sales numbers. You've seen that with a lot of the consumer numbers. So we think that, again, the U.S. economy is driven 2/3 by consumers. And so that's a positive. You have all this money sitting on the sidelines in terms of consumer excess savings, and they are spending. So you saw the great numbers today out of Home Depot and Walmart. But we're just a little bit cautious on the market. We think the equities have gotten a little bit ahead of themselves, given how much they've appreciated this year for earnings that are going to decelerate to high single-digit growth next year.
And so tell me about what your margin outlook is for next year. How long does a consumer continue to drive the gains? When does the tipping point come?
So there are a number of factors that go into what the margin is going to be for next year. We do think the consumer is very strong. Again, the $2.6 trillion in excess savings, that's a couple of months worth of spending right there. You're seeing wages go up. So we do think the top line, the spending, is going to be there for a lot of these companies, particularly the consumer-driven companies. But where companies might run into trouble, of course, is in costs and the supply chain issue. And it's interesting, if you look at the difference in how Home Depot and Walmart reacted today, both of them had pretty strong top-line beats and decent earnings beats. But the difference is that Walmart had a cost issue and their margins were below expectations, whereas Home Depot's were much better. And I think that's illustrative of what we're going to see going into 2022 is who can actually handle the cost increases better. Now, there are some early indications that maybe some of the supply chain issues might be easing a little bit. You have seen lumber come down a lot in the last couple of months. And there's some indications that shipping might be easing a little bit. The Baltic Dry Index is down. So it's not enough data to be conclusive yet, but it is something we're watching. But if we see inflation stay hot, that 6% print that we saw earlier, then that's going to be a problem for companies that can't pass along those increases next year into 22.
And what do you think are some of the biggest hurdles for the stock market to get over next year? Is it going to be the Fed and the specter of higher interest rates? Is it going to be a prolonged inflation? Is it going to be all of the above?
Yes, absolutely, all of the above. The Fed is walking a tightrope here, as we all know, because they don't want to clamp down this expansion too early. But at the same time, they're running the risk of being behind the curve, as a lot of commentators have noted. And so we're looking at tapering over the next several months and then increases starting probably middle of next year, although who knows when exactly that will increase. But I do think that the Fed's impact is going to be pretty significant in terms of how the market handles next year. And we also look to the bond market to try to figure this out. And right now, the bond market is assuming that the Fed is going to start raising rates maybe a little bit faster than the Fed thinks it is.
I want to ask you, where should people be positioning their portfolios to deal with this extended higher inflation?
Well, one of the areas that we have continued to be overweight is banks and financials. They benefit from higher rates. They benefit from a steeper yield curve. You have JP Morgan and Bank of America both trading at under 2x book value and mid-teens on earnings. And with a growing economy and growing GDP, they can continue to have loan growth and strong credit quality. So financials is definitely one way to do it. Another thing that we've been advocates of for the last several months, really over a year now, is looking at real assets, and particularly areas like timberland, infrastructure, real estate. So we're overweight real estate investment trusts, and we're looking at infrastructure funds as well as a way to protect against higher inflation. And then lastly, you want to be careful about owning too many companies that are exposed to low-wage workers, because those wages are going up double digits in terms of the minimum wage as labor has become so scarce.
All right, we're going to leave it there. Thank you so much, Ellen Hazen, portfolio manager at F.L.Putnam.